Good afternoon, everyone. Thank you for joining our webinar today. Donald Trump's victory in yesterday's U.S. election was one of the latest in a string of surprises to hit investment markets. The long-term impact of his policies on investors will become better known in the coming months as he appoints key leaders in his administration. Today, we are taking this opportunity to express to you how Morningstar's research and investment teams are responding to this new reality. First, a few administrative items. Please note this important disclosure. You also have the opportunity to submit questions via the WebEx chat box. You'll find that, I believe, in the lower right-hand corner of your screen. Joining me today are a panel of Morningstar subject matter experts from across our research disciplines. Christine Benz, Director of Personal Finance. Elizabeth Collins, Director of U.S. Research, Equity Research. Erin Shapiro, Director of Policy Research. Paul Ellenbogen, Head of Global Regulatory Solutions. Robert Johnson, Director of Economic Analysis. Dan Kemp, Chief Investment Officer, EMEA for Morningstar Investment Management in London. Dan McNeela, Senior Portfolio Manager and Co-Head of Target Risk Strategies. Jeff Patak, Global Head of Morningstar Manager Research. And myself, Sil Flood, Chief Content Strategist. Our agenda today will survey several important questions related to this event. First, what should investors do? Second, what is the impact on Morningstar's fund analyst ratings? How will our view of stocks be impacted? What will be the impact on Morningstar's investment strategies? How might the regulatory landscape change? How are non-U.S. investors viewing this event? And finally, how does the election result impact our outlook for GDP growth and employment? Christine, what should individual investors do?
Thanks, Phil. One thing you often hear when you have market shocks or near market shocks is that everyone should stay the course. And I generally think that that's decent advice. But I do think that advisors with their clients can use these market inflection points or near market inflection points as a reason to talk to their clients about the virtue of rebalancing their portfolios. Anecdotally, I talk to a lot of individual investors, and I am sensing a little bit of complacency about equity market risk when I talk to our individual investors on Morningstar.com. So I do think that it's a good time to go back to clients and talk about, well, if we haven't rebalanced this portfolio in a few years, meanwhile you're a few years older, equity market valuations have gone up, let's take a look at where we are relative to where we want to be in terms of your asset allocation. So one quick illustration I often give our Morningstar.com readers is, let's just look at a 60% equity, 40% bond portfolio back in 2009. Today, assuming that portfolio has not been touched at all, it's about 80% equity, 20% fixed income. So you're 7 years older and the market valuations have gone up on average. So I think that's a good way to express how a hands-off portfolio can inadvertently become more risky than perhaps you intended as an investor. I was recently talking to Vanguard about its client equity allocations. They told me that for 65-year-olds, the typical IRA investor with a Vanguard portfolio has a 60% equity weighting within Vanguard's own glide path, so they're considerably more conservative. And there may be good reasons that clients themselves are maintaining those higher equity exposures, but I do think that perhaps there's a little bit of complacency given how strong the equity market has been for so long. In terms of specific counsel about asset allocation, obviously it's very individual specific, but one of the key topics that I talk about when I talk to individual investors about managing their own asset allocations is this idea of risk capacity versus risk tolerance. So clients are familiar with the concept of risk tolerance, how much loss can you take without incurring sleepless nights and so forth, but the concept of risk capacity is a lot more important in terms of positioning the portfolio. So the way I think of it is, if you incur losses, and you can sort of stress test this with your clients, if you incur losses of 10%, 20%, will this have a meaningful impact on the plan that we've laid out for you? If you're getting ready to retire, will big losses leading up to retirement mean that you'll have to push your retirement date out? Or if you're already retired, will big losses owing to a too high equity position cause you to have to rein in your spending? So I think that risk capacity question is a fundamental one, and one well worth discussing with clients at this point. I'm also a big believer in the idea of retiree portfolios in particular having adequate liquid reserves. Of course, as advisors know, liquid reserves have been dead money for the past 7+ years, even longer, but I think there is a value from a client peace of mind standpoint to having adequate liquidity in the portfolio. This is sometimes called the bucket approach to retirement portfolio planning. I usually counsel 6 months to 2 years worth of living expenses set aside in true cash instruments. I also think it's a great time to revisit the virtue of having ballast for the equity portfolio and having true ballast in the equity portfolio. When we look at investor flows, one thing that we see is this very strong appetite for income, and in some cases investors have been gravitating to income-producing securities, income-producing funds that do in fact have higher income streams, but they also have a higher correlation to the economic cycle and a higher correlation to the equity market. So taking a look at that ballast that you're using in client portfolios, making sure that you do have some high-quality fixed income exposure with the potential to hold its ground if we do see additional equity market shocks from here on out. The last point I wanted to make is on taxes. As we wind down 2016, people are often thinking about what sort of tax maneuvers they can make before year end. One of the key ones to take a look at for advisors is for clients who happen to be in the 10% or 15% income tax bracket. One of the most profitable things you can do, in my view, is to harvest tax gains in the portfolio, long-term capital gains, because clients in that income tax bracket are in a 0% tax rate for long-term capital gains. So that's probably the layup strategy. Unfortunately, that is something that will only be available to the folks who are in the 15% income tax bracket or below. Tax loss sales, obviously something you hear about this time of year, given the strong run we've had in the equity market. Fund investors will probably be hard-pressed to find good tax loss sale candidates unless they're using the specific share identification method for tracking their cost basis. In that case, maybe they can cherry-pick some recently purchased lots and identify some tax loss candidates there. Conversions from traditional to Roth IRAs, that's a strategy that's going to be a better strategy in down markets than it will be in strong ones. In fact, I think that working with a tax advisor, you may be able to find better opportunities to convert traditional IRA assets to Roth. But, of course, it's very individual specific and very much dependent on the investor and what his or her tax bracket is today versus what he or she expects it to be in the future. So I'll just leave it at that. I think, in general, my main takeaway is that it's a great time to revisit equity allocations because I think investors have been perhaps inadvertently stepping out a little bit on the risk spectrum, especially those investors who are closing in on retirement or already retired.
Great. Thank you, Christine. Jeff, what, if anything, is going to change in our Morningstar analyst ratings for funds?
Thanks, Phil. Yeah, nothing will change in our Morningstar analyst ratings for funds. For those who are unfamiliar, the analyst ratings for funds, they are qualitative and forward-looking. The organizing principle when we're doing rating setting are 5 pillars that we use. Those are people, process, performance, parent, and price, respectively. We're making an assessment in each one of those areas to try to get a sense of what a particular fund's investment merits are, how likely it is to outperform a relevant peer group or index over a market cycle. And market cycle is the operative term there, and it goes back to explain why this isn't a precipitating event for us in terms of ratings changes, why you're not going to see us make sweeping ratings changes across the thousands of distinct strategies that we cover globally. You know, certainly this is a significant event in markets, in sort of social and political spheres. There's no denying that. I think it's quite uncertain what the implications will be over the course of a market cycle. And I think that's what most investors need to remain focused on is, what their goals are for the future and whether or not they have a plan that conforms to meeting those goals. And generally speaking, trying to sort of chase it or making changes willy-nilly to your funds allocation on the basis of a short-term event like an election outcome is probably going to do more harm than good. And we actually have some research that we alluded to in a piece that we put out this morning that my colleague Russ Kinnell publishes every year. It's called Mind the Gap. And it shows the toll that inopportune trading has taken on investors. They cost themselves generally 1 to 2 percentage points per annum by, in essence, buying high and selling low. And when do they do that? Unfortunately, they do it often at times like these when emotions are up and we let our guards down and we succumb to impulse. And that's something we certainly don't want to do, and we don't want to send that message with our ratings. We want to be very focused, intently focused on our market horizon, which is longer term, and that explains why this isn't going to result in sweeping ratings changes. Maybe just to build for a moment, though, on something that Christine mentioned earlier about complacency setting in. One of the things that we strongly encourage our analysts to do, and then also I would encourage investors who are looking at their funds at this moment to do is, make an assessment of the manager. Is he or she complacent about the level of risk? Are there some things that appear to have gotten, a bit askew in the portfolio? Perhaps, it's drifted into a part of the market that's somewhat unfamiliar terrain for that manager, given what we know of their investment style. Perhaps they've had a bigger allocation of cash in the past and they want to keep up with the Joneses now, so they've let that dip down a bit. Those are all useful progressions for us to go through as investors, not just for today in reacting to the election events, but also just sort of in the normal course in evaluating our fund investments. And then we can make a more prudent decision about whether it's something that is in keeping with our plans and something that we want to remain a part of our allocation. But no ratings changes for us right now.
Okay. Thank you, Jeff. Elizabeth, what will a Trump presidency, what impact will it have on our bottom-up valuation models for companies?
Thanks, Phil. That's a really good question. I think at this time it's really important for the equity analysts and those who are investing in individual equities to remember that we have some important principles here at Morningstar. That is that we are valuation-driven, we focus on the fundamentals, and we have a long-term time horizon. What we can see, especially overnight, is that the market reaction was that a Trump victory was largely unexpected. And to the extent that our analysts were implicitly or explicitly modeling the status quo in the absence of significant indicators that they shouldn't, our valuations also largely implied a Clinton victory. So as we incorporate new fundamental information, as we always should as equity analysts, it is possible that some of our fair value estimates will change, and some already have, which I'll talk about later. But that said, I'm encouraging my own analysts and I'm encouraging investors that we should focus on only fundamentally necessary changes to our assessments of intrinsic value and try and tune out the noise and the uncertainty that is not fundamental. And at times like these, it is tempting and possible to make the shortcut and a possibly faulty analysis that short-term market uncertainty will have a material impact on long-term cash flow drivers. At Morningstar and Equity Research, we use DCF models to value every single one of the companies we cover, and we know that the cash flows that are generated over the next 5, 10, 15, 20 years are the most important to our assessment of intrinsic value, not what happens in the next days, weeks, or months. Every single time we have a new president, we have a long wish list of what they want to accomplish. But what our equity analysts have to do is model in the most likely outcome for which policies and wish list items of the new president will actually get enacted. And to this end, I'll go through some of the things that we've been publishing today, in which you can find on any of our website platforms. There are a handful of research pieces that I'm going to list now for you and then go through in very brief detail. You should look for our note on the defense industry called Despite the Surprise Trump Win, our long-term thesis on defense contractors remains intact.
Secondly, on Western Union, a Trump presidency raises risks for Western Union. Thirdly, on the financial sector, while Trump victory may increase volatility, there are some long-term positives for financials. Number 4, for steelmaker stocks, Trump win sends U.S. steelmaker stocks soaring. We expect to raise our steel fair value estimates only moderately, though. And in the tech sector, we have software should remain resilient in a Trump world, but long-term implications exist. And finally, in consumer land, heightened post-election uncertainty presents long-term investors with consumer stocks to feast on. And that's only what we have published so far. There's more notes coming out from industrials probably as we speak. Just to briefly touch on each of these a little bit. Regarding the defense industry, a Trump victory is more bullish than it would have been if Clinton had been elected. That said, it's still to be determined if Trump's wish list will get adequately funded. We know that he has said he wants to increase the size of the Navy, including both ships and aircraft, and he wants to modernize the U.S. nuclear triad. So there's modestly positive pressure on our defense industry fair value estimates. For Western Union, this is a company that its business model is exposed to immigrant repatriation of cash back to their families, ex-U.S. And there is a fundamental impact on Western Union because of yesterday's outcome. And we have lowered our fair value estimate and increased our uncertainty rating. In the financial sector, there is the heightened probability of increased volatility in the near term, which is a fundamental negative for the asset managers. But longer term, this raises the possibility that the DOL will be watered down, although that's probably unlikely. And there's the increased probability that banking regulation will be watered down, which could reduce some operating costs for the banks we cover. For steelmaker stocks, we have published that we do indicate to we do anticipate modestly increasing our fair value estimates, although not as much as the market has reacted today. A Trump victory is positive in two ways for steel manufacturers in the U.S. One, he has promised with his victory speech that he will embark on a stimulus program. Secondly, he has been very anti-trade in rhetoric, and he wants to protect the U.S. steel industry. On the first one, it remains to be seen how the stimulus will be funded, and like past presidents, he has said that he will use public-private partnerships or incentives. This has been said before, so the full impact and the magnitude of the stimulus are still big question marks in my mind, and especially in terms of how much demand they will create for steel stocks. On trade, again, the benefit to U.S. steel producers from protectionist trade measures are far from a high magnitude positive. Number one is commodities are globally fungible, so if we enact trade regulations on one country, we might get imports from another. There's also the specter of retaliatory trade measures. And finally, if trade measures impact our economy, it could hurt consumer demand for steel and commodities, which is why our impact on the steelmaker fair value estimates will likely be less positive in magnitude than what the stock market is indicating this morning. In software, we are maintaining our moat ratings on the enterprise software names that we cover, and we think that the most important driver of the competitive landscape there will not be regulation, but just the large secular shift to the cloud. And we're taking this opportunity to highlight some best ideas in software, including Salesforce.com, as well as Blackbaud and Guidewire. In consumer, there are a variety of uncertainties and fundamental issues at play here, but we're taking this opportunity to highlight undervalued Hanesbrand, Procter & Gamble, and Starbucks, who should not see their long-term cash flow drivers materially impacted by today's outcome. However, there are companies, particularly ones that send consumer goods, for example, from Mexico to the United States, that could see some of their earnings weaken, especially if some of Trump's more anti-trade ideas come to light. So please stay tuned. We are publishing notes practically every hour in terms of the fundamental impact on fair value estimates, but by and large, our analysts are sticking to their prior fair value estimates.
Great.
Thanks, Bill.
Thank you, Elizabeth. Dan McNeela, Morningstar manages money. What is Morningstar Investment Management's view on yesterday's election?
Right. Well, thanks, Bill. And so my team manages multi-asset class portfolios, and I'd say in the immediate wake of the surprise election of Donald Trump, we didn't have any changes to make to our portfolios. We are not macro investors. We did not have any positions in the portfolio based on the expectation that Clinton would win, and so we had no positions that we needed to unwind when the surprise Trump vote came through. And I think if we take a step back and try to figure out just how tough it is to be a global macro type of investor, in this case, you would say that first you would have to have had the election results predicted correctly, and not too many people did. And then if you did have that correct prediction, you would have to also be correct about what the market response would be. And if you were watching last night as the election results came in, you would have seen that U.S. Stock futures dropped by more than 5% as it became clear that Trump was going to win. But then the market decided to change its mind, and the stocks opened flat this morning and now are trading at modest gains. And so, again, even if you have that first prediction correctly, you also have to get that second prediction about what the market's response is going to be. It was also true with respect to interest rates. Interest rates began to fall overnight on the news, but now in the morning they've been rising fairly dramatically. So the market again seems to change its mind to the immediate response to Trump's election. So what do we do here? And Elizabeth summed it up for her equity team, and we follow the same principles with our multi-asset class portfolios. In short, we're long-term valuation-driven investors, and that's what we stick to when we're positioning our portfolios. As Christine highlighted earlier, we agree that there is some complacency in U.S. equity markets. We think U.S. stocks are generally expensive relative to their own history and relative to international stocks, and therefore our portfolios tend to be underweight their targeted allocations to U.S. equities. And also with interest rate risk, we have been underweight the amount of interest rate risk our benchmark has. We've been protecting our portfolios against the possibility of rising rates. Again, not because we had some view on the outcome of the election or what the Fed was going to do at its next meeting, but because we look at the risk-reward trade-offs there, and we see historically low yields for long-term bonds. We think that the risk of rising interest rates is a very definite possibility and potentially impactful to portfolios. And so it's not a trade-off we want to take where we can get marginally higher yields from long-term bonds and also take on that extra risk. So we're positioning our portfolios fairly defensively, but not for any macro concerns or short-term decisions about what's happening in politics or at the Federal Reserve, but we're being guided by our valuation discipline, and we're sticking with that to guide our portfolios. And I'd say the only thing that we want to be aware of is that when there are some surprises in the market and there tend to be dislocations, that's often the time that value investors find the best opportunities to take advantage of those dislocations, buy into underpriced assets, and hold on to them for the long term when those asset classes can come back and return to their fair value. So that's my summary, and let's move on to the presentation.
Thanks, Dan. So we have Paul Ellenbogen and Aaron Shapiro here. They are our policy experts. Gentlemen, how will the regulatory landscape change potentially with the Trump presidency?
Well, so starting with the most important recent regulation, the Department of Labor's fiduciary rule, our view since before the final version of that rule passed has been that it will accelerate current trends. Our view now is that those trends won't go away. There may be some disruptions or bumps along the road, but we believe there are forces bigger than regulation that are impelling these changes. So just briefly, a list of the things that we think will likely continue rather than be interrupted or stopped because of the recent election results. We've seen a trend from active to passive management and a corresponding move towards lower cost investment vehicles. We expect that to continue. we're seeing a lot of pressure on both the fees for asset management as well as administrative and operational costs as people look for lower overall costs as well as lower portfolio management costs. We're seeing increasing demand for transparency at every level, from the individual investor to the financial intermediary to the institutions that offer investments, and we think those demands will continue. We will see either or both of an expansion of the number of share classes of investments or a decrease in simplification of share classes. Again, the forces compelling those trends will continue regardless of who's in the White House. For those who distribute investments to individuals, we've seen and will continue to see, we think, a shrinking of product shelves. Broker-dealers will be looking to offer fewer investments, to have more narrow but deeper relationships with a number of asset managers, and that will continue the pressure on asset managers to become one of the surviving providers rather than one left out in the cold. We've seen a lot of recent outcome-based and risk-based investment strategies offered. There's still something of a contention between the asset managers moving into the realm of the investment advisors. The investment advisors will continue to push back and insist they should be the portfolio managers. So that struggle and contention will continue, with a cost element, of course. The move from brokerage or transactional-based advice towards fee-based planning, that's something that predates DOL by a number of years, and we don't see that contest diminishing in any way. In fact, we expect that will continue. The focus on asset allocation as opposed to single security selection goes along with the emphasis on planning as opposed to brokerage or transaction, and we don't see that going away. So more and more asset managers will have to think about how their products fit into a planning or portfolio context. Again, a change in the White House doesn't eliminate that. We see a focus on financial planning and proving the value of financial planning. The main impetus of that is the arrival of so-called robo-advisors who use algorithms that can work at night to provide what traditionally has been a rather expensive and human-powered service. Robos don't go away, in our view, just because there's a new occupant of the White House. And finally, fiduciary concerns that operated previously in the qualified plan world will remain fiduciary concerns. The litigation around plan fees, the litigation by plan participants against plan sponsors is not likely to diminish. ERISA remains in effect, and how it carries over to the DOL or even to the SEC remains to be seen, but we don't think that fiduciary pressure on financial intermediaries will go away. So that's our view. Some change to the same, but in a sense more of the same along the lines we've described. And to Aaron for how things might shake out in Washington.
So I think it's important to keep in mind that with respect to the DOL conflict of interest rule, it'll be quite difficult for President-elect Trump to unilaterally get rid of the rule in between January 20th when he takes office and April 10th when the rule goes into effect. Simply put, this was not an executive action that can be done quickly. It was done through administrative rulemaking. And that means to undo it, it would have to go through administrative rulemaking. That means putting out a proposal and explaining the rationale behind that proposal, collecting comments, proving you've read every comment, and then putting out a final rule. And that's really much too much to do in less than 3 months. And it's particularly too much to do since he'd be relying on the career civil servants that just spent quite a number of their years of their life putting out the conflict of interest rule in the first place. Over the longer term, there's certainly a lot of actions that a President Trump can take if this is in fact a priority. On the legislative side, of course, the House and Senate could make it a priority to change the way that ERISA works so that DOL would not have the authority to take some of the actions they did with the conflict of interest rule. But so far, we don't see any signals that that's likely to be a top priority. There are much bigger priorities that they've signaled in terms of health care that will probably take up a lot of the energy, at least initially. So that's our view for right now.
Okay, great. Thank you, Aaron and Paul. Dan Kemp, you've had a long day in London. Tell us what you're seeing from the United Kingdom.
Hi, Sil, and good evening, everyone from London. Yes, it's felt like a very long day. When I woke up this morning, I think it's fair to say that along with most other people in this country, and I imagine most other people outside the US, we were shocked, but not surprised. It felt very much like a rerun of the Brexit vote that we went through at the back end of June. Even more so because Trump, during the campaign, you might remember, promised Brexit plus, plus, plus. And so the temptation is to draw parallels from that event to this. And that temptation was reinforced by the initial market reaction, which was very similar. Share prices, or in the case of the U.S. futures, in home markets fell sharply as the news turned towards the Trump victory. And again, Japan bore the brunt of the result, as it did back in Brexit, with the yen rising strongly and Japanese share prices falling. But there were some differences, and the main difference was in the way that bond yields have reacted. And you've already heard that bond yields rose in the US today, whereas in the UK they fell. And that difference, that small difference in market reaction, does provide a clue that Brexit and the victory for Trump, although they're drawn from the same well of popular discontent, they seem to be different in a couple of really important ways. The first is that Brexit is likely to be a permanent, or at least a semi-permanent change in the trading status of the UK within Europe. And so we have to assume a very long-term impact from Brexit. But as you all know, Trump will be term limited and may lose control of Congress a long time before the end of his presidency. And so it's not permanent in the same way that Brexit is. Second, the Brexit vote has forced the UK into very difficult trade negotiations with the rest of Europe just to maintain the status quo. Our politicians are going to have to work extremely hard to get similar access to the European market, our main trading partners, as we had before Brexit. Whereas, in contrast, Trump, although he has vowed to reform some trade deals, doesn't have to do anything to maintain the status quo. So he can only change the status quo by his own action, and obviously that of Congress as well. So although he's promised to disrupt, it is much easier for him to maintain the status quo than it is in the UK. And so I think for those two reasons, Brexit is actually a very different event from the election that we've just lived through. And so we think it's likely that Trump will have less of an impact on the long-term fair value of assets than Brexit is likely to have. But of course, this event is likely to be accompanied by volatility. And as previous speakers have mentioned, volatility can bring with it some great opportunities to acquire assets that are trading below their long-term fair value. Now, at present, as Dan's already said, we're tending to find those opportunities outside the U.S., in Asia and the emerging markets primarily. But this may extend to U.S. assets in due course if the volatility is increased, if Trump makes some early stumbles. And so we'll be looking out for those sort of opportunities through the course of the next few months. And while from a UK perspective, of course, we're going to have to live through, as you all are, an enormous amount of media speculation that's going to be dominated by the potential impact of a Trump presidency, I think today has really provided us with another example that engaging in political speculation or taking your cues from very early market movements is really just folly. And so while Trump appears to be gearing up to be the most unpopular president in living memory as far as the rest of the world is concerned, or certainly as far as their traditional allies are concerned. We are looking through that popularity and really focusing on what investors should be doing, which is looking for or looking at the long-term valuation of assets and estimating the opportunities and threats that are posed by valuations. Back to you, Sil.
Okay. Thanks, Dan, for joining us so late in the evening. Now, finally, we have Bob Johnson. Bob, how does the election results impact our outlook on GDP growth and employment?
Yes, absolutely. I think, the one thing to keep in mind, the markets seem to get wrapped up in, Fed decisions and Brexit and now Trump. One thing we like to keep in mind in Morningstar that we think will be a key driver in asset allocation and what's going to do well and how well economies will do is the demographics around the world. The slowing population growth is certainly there, and not only that, but that population is aging, moving into the years where they're drawing on their savings and where they're spending on far different things than they used to. And so demographics still remains our key economic focus, and we've been projecting slower economic growth, say more like 1.5% to 2% here in the U.S. For some time now, down from kind of a 2 to 2.5% that we've had for most of the recovery. So we've already kind of been at a lower range, and some of what Trump is doing, and the uncertainty around it certainly may not be helpful and may slow economic growth a little bit in the short run, but I don't think enough to really to move my 1.5% to 2% long-term prospects. I am more concerned about some of the micro things that are going on right now. And if you take a look at the slides that I put out there, I've shown a couple of the key things that have really driven this recovery, and these are year-over-year growth rates. And again, kind of unrecognized some at different points in time. I mean, I guess we now realize oil and gas was more important than some people thought. You can see that's got a clear line that's peaked and come back down. Autos, which had a great recovery, been a key driver in this recovery, peaked a fair amount of time ago and then had a subsequent kind of re-peak, if you will. And airliners, driven a lot by what was going on in Boeing in the commercial market, offset partially by what was happening in the defense market, have clearly slowed up a bit and aren't contributing the way they were. Now, if you look at some of the things more on the right side that have peaked out, you can see that healthcare, restaurant meals, and a couple of other things have also begun to slow that are kind of unrecognized drivers in the economy. So I think those things are continuing and continue to be an issue as we look at economic growth, and are probably more worrisome than whatever Trump decides to do. And just again, I won't spend a lot of time on the next slide. We talk about GDP growth. We note that the year-over-year rolling 12-month GDP growth has slowed from almost 3% down to about 1.6% currently. So we've already slowed down a bunch, and we think this is more to do with demographics and being towards the end of an economic cycle than anything to do with Brexit or the Fed or uncertainty about the Fed or Donald Trump. And certainly you can see in this graph, it's also even dependent on employment and hours worked growth. And you can see the very tight relationship there. And unfortunately, both those lines continuing to move downwards. So we've got concerns about the economy even before the Trump issues might have arisen. Certainly, the next slide, we talk about inflation has been heating up, especially on the services side, especially rents for some time. It's really been a process that's built and it's been kind of masked by gasoline prices and energy prices, and more recently, the dramatic fall in grocery prices. And as we come out of those, benefits, I think that inflation was due to pick up anyway. Now, one of the key market worries right now is his policy, Trump's policy, may be inflationary. Obviously, he's got tax cut plans along with increased infrastructure spending. That doesn't paint a particularly good picture for the budget or for inflation or for interest rates. So certainly that's probably part of what we've seen in the move in interest rates today. So certainly inflation is one of those things we're really watching relative to Trump. And if obviously he puts up trade barriers, one of the things that does is it inflates local prices, and it certainly is not a great thing for inflation. So the market's not wrong to worry about inflation that was already a little bit problematic. Turning to the next slide, he's talked about immigration and limiting it. So much is driven in the economy, people don't realize, by the population growth. And certainly immigration is a big part of that. And certainly you can see from these graphs that foreign-born workers have gone from something like 15% of the workforce to pretty close to 17% in kind of less than 7 years. The data doesn't go back a lot further than that, but it's certainly something that's been on the rise. And without that, GDP growth would have been considerably less. And you can see on the bottom line, that top blue line, the one that's kind of the high growth rate, that's the non-U.S. born workers. And that's not a bunch of people frying burgers. I mean, this is people that are computer engineers, a lot of high-end workers that are vital to the growth of the economy. And as he really implements his aggressive immigration reduction program, that certainly rolls out a major pillar of U.S. growth. And certainly we've seen countries that have poor immigration growth, like Japan, have really been killed in terms of economic growth. Europe, who hasn't been a wonder child on the immigration front, but at least has some, has done better. And the U.S. over the last 5 years has done the best of all because of our relatively loose immigration policies. Certainly, Elizabeth touched on healthcare a little bit. Again, over the last 60 years, that's gone from 5% to 15% of the economy. He's clearly made, getting rid of Obamacare one of the pillars of his campaign, and clearly we don't know what parts of it he really wants to kill, and he'll get congressional approval, and some of it is extremely popular, covering up the 26-year-olds, the Medicaid provision for the low-wage workers. A lot of things have made this the pre-existing conditions things are all huge deals, and that a lot of people really like. And so, yeah, people hate the mandate, and small businesses hate it. But again, it's been something that's been helpful to the economy. It's been helpful to economic growth, and certainly the uncertainty around that's going to be a big issue. And I think Elizabeth highlighted a couple of up and down industries that may result from all the things happening in healthcare. But it's a big part of the economy, as you can see in these charts, and clearly it's been a part of this recovery, and we'd hate to see it get upset. Certainly with the trade policy, we've all touched on the imports and exports. Exports are about 12% of U.S. GDP, so slowing there was not great. Unfortunately, it's more impactful on the people that he wants to shut out. So the trade policy is more likely to have an impact on, say, China, Mexico, other parts of the world, emerging markets that are those are more likely to be impacted. And certainly one of the hallmarks of today is that the U.S. market has actually done relatively well, perhaps because of the stimulus, partly because some was thought of. I don't know. But in any case, U.S. market's okay, but emerging markets are down about 3%. And certainly part of that's related to trade. And obviously trade, one of the other issues going on there is that trade was already in the dumper because the U.S. Residents are spending more on experiences and not goods, and that's already meant, we've had a very unusual situation, even with a strong dollar, where the U.S. has drastically reduced their imports. And that's certainly not great news for the rest of the world. And certainly we've already touched on Brexit, as you can see on the next slide. With Brexit, we had the big fall, and then right now UK stocks are far above where they were before the whole thing began. So beware of sharp moves in either direction, because what happens the first day isn't necessarily the long-run approach. And certainly, I mentioned it was bad news for emerging markets. You can see on the next slide that from the inset block this year, developed markets performance has been about 1 or 2% in terms of stock performance. Emerging markets are up Flows have begun to flow back into emerging markets. You can see that by the blue line going up and out of developed markets, the red line going down. And unfortunately, that's just caught things on the wrong way of today, whether that's going to be long-term and enduring. But certainly a trend that was starting to look like it was going the right way is certainly reversed rather drastically. And, we've all touched on this idea that we're all very valuation-driven at Morningstar. This next chart that I show is a pretty neat demonstration of Morningstar price to fair value and some of our technologies here to roll all of that up. And the orange countries are countries and areas that are overvalued, and the blue are the undervalued. And you can see the oranges are pretty dominating in that map, and there are some blues in the European area that might be some temptations. But clearly, to have this uncertainty in a world where we've already got stocks modestly overvalued is perhaps even a catalyst, this Trump thing, for people to kind of realize, oops, we are a little bit overvalued, the complacency that Christine spoke of. And finally, I won't say a lot about it, but I just put in one slide here as a placeholder, kind of remind me to talk about the Fed. Certainly, if we had thought maybe markets would continue to be down this morning, and certainly if markets were down, if there was world instability, the feeling was, well, the Fed would stay looser for longer, and the December thing might be off the potential rate increase might be off the table. So that was certainly one thought in the very short term, but over the longer term, we think it might force the Fed to move more aggressively when they move. We've mentioned inflation has been an underlying problem, and clearly some of the policies he has in mind are quite inflationary. And so I think clearly the Fed may be more tempted to raise faster and more often instead of maybe kind of one small rate increase in December and one small sometime next year. We may have none in December and then a bunch next year depending on how much worse inflation actually gets. So again, in a world where we've got kind of a slowing economy, it'll be very interesting to see how they come out on it. Not a clear-cut answer on the Fed, that's for sure. So that concludes my comments, and I think there's other issues that are a lot more important than Trump, but certainly on the rate side, it seems like it could be impactful if indeed we get tax cuts and spending raises simultaneously.
Okay. Thank you, Bob. That concludes Morningstar's prepared remarks for the webinar. We do have several questions that have come in through WebEx, and a few of them are related to immigration. So this question is really for Bob and Aaron and maybe Paul. The question is, given that the prospect of regulations regarding the immigration of skilled labor may become more restrictive in the future, what is preventing U.S. workers from filling those roles?
Well, I think that in some cases the U.S. workers may fill those roles. In some cases, they just weren't available. I mean, we're slowly working on that less, and it was a little bit easier to grab people from the outside. And certainly there's some disinterest by students in STEM type vocations, and certainly there are some issues there. And I think that yes, they may get filled. And I know, I've got some friends in Seattle, and they tell me periodically that, some of these H-1B visas and so forth, there's always a thought that, yeah, maybe they couldn't find it overseas, but yeah, it's also kind of a hammer to keep wages down. And so it'll be a little bit interesting to see where the truth comes out on that. But again, yes, there is a certain benefit that certain categories of U.S. wage earners may move up because of a shortage of workers, and that there may be some more willingness to hire U.S. workers in some of the tech industries. But it's a fascinating question. I think that indeed it won't be entirely negative that these people are shut out, but I certainly, as an economist, it doesn't seem like the right thing to do.
Aaron, to the extent that it was articulated by the Trump campaign, did they address skilled versus unskilled immigration policy, or is this something that's just been spoken and not written?
So, I mean, this is a pretty hard thing to address because to the extent that we've gotten dribs and drabs of policy positions, they tend to be kind of fragmented, they tend to be kind of contradictory. What I will say is that what Trump really did emphasize is that he wanted to enforce the laws that we already have. And so, and that's something that he can do, on his own and relatively quickly. So, I think that's probably where we'll see more immediate action.
Okay. Question from the audience. Are clients with more categorically concentrated equity portfolios like the dividend portfolio at too much risk of these kinds of macro-level events that drive market uncertainty?
I'll take that just from an asset allocation perspective. In our multi-asset class portfolios, it's one of the key questions that we are always circling back to is how much equity risk do we want to have in the portfolio versus lower volatility options like fixed income. And we can talk all day about how disappointingly low yields are in fixed income markets, but the truth is that bonds tend to be much less volatile than stocks are. And so I'd encourage investors who are leaning heavy on an all-equity portfolio to take a look at all of their investments and make sure that they're in the right place from a risk perspective and they're able to handle whatever short or longer-term downturns there might be in equity markets if we do run into that. And I don't know, Christine, if you have some additional comments around that.
The way I think about it, and I certainly talk to lots of individual investors who love their dividend-paying stocks, they love their dividend-paying funds. My counsel is to think about holding equities only for the portion of your portfolio where you have at least a 10-year time horizon. Over 10-year time horizon stocks are really quite safe because they have positive returns in most 10-year rolling periods or have historically. But at the front end of the portfolio, I do like healthy stakes in cash and high-quality bonds. In the model portfolios that I put together, I typically think of years and years view as going a bond or stair-stepped by risk level. And that's not saying that that's the sequence in which you would withdraw from that portfolio. You may actually withdraw your cash flows from the equity piece if you wanted to rebalance, but I do think having that good front end of high-quality investments provides a good buffer and provides some psychological peace of mind for holding that equity position.
Yeah, and I would just caution, too, a little bit. I mean, on the dividend side, I as the economist, have a little bit more of a worry about rate, which obviously is not good for dividend-yielding vehicles necessarily. And the other thing is that it does not do well. I mean, Elizabeth said that a lot of dividend-paying stocks are bank stocks, and certainly there's some pluses and some minuses going on for banks. I mean, this increased volatility may actually help the trading desk of some of the banks, although that operation has been cut back at many banks. Lower rates, if they stay lower for longer, is bad for banks. If rates go up and the spreads increase, it's good for banks. I'm not giving you an answer. But just in a dividend portfolio, be careful that you don't end up all in one class of stock, because a lot of the dividend payers are utilities, which are facing growth issues with a lot of utilities. And the other mentioned that the outcome is kind of unknown here. So that's the one thing you have to worry about when you concentrate by dividends, is you may end up with a more clustered set of industries.
Thank you. So we have a related question, and again, it's for our investment management team. Will MIS rebalance the retirement income portfolios?
So the retirement income portfolios have just gone through a rebalancing. So I would say look to the investment management website and get caught up on that. We do meet on a regular basis, at least monthly, to re-look at our fair values on the different asset classes, and the retirement income portfolios are subject to reallocation when we see a big enough market move away from where they were when they were last reallocated.